This episode is sponsored by Lupton Capital, which provides a variety of investment services to both retail and institutional investors on platforms such as Seeking Alpha, Substack, and StockTwits. For more information on these services or for links to those services, please visit luptoncapital.com. Hey, everybody. Welcome back to the Investing with the Whales podcast. My name is Jonah Lupton. I am your host. Super excited today, as always, to have another great guest. Today, it is Theta Warrior. Theta, how are you?
I'm good, Jonah. Thanks for having me on, man.
Thanks for coming. So I know this one's going to be a little bit different because I know you do maintain an anonymous profile on Twitter.
Yes.
I don't know. I mean, I have my guesses as to why, but everyone has their own reason. There's plenty of anonymous accounts on FinTwit. I feel like probably half of them nowadays are anonymous. And I know people with burner accounts and all that stuff. So and I've even thought about starting up an anonymous account just so I can start tracking people a little bit closer. But anyways, I know you're an experienced options trader, correct?
Yes, I trade options for a living, and I've been doing so for the last 5 or so years professionally. All of my basic decisions are based off of the technicals and the options flow. So everything that I do, comes down to what price action is telling me and which way the momentum is being pushed, by the actual options market itself.
Do you typically do options in individual stocks or ETFs, the indexes? Like what's your focus?
Yes, of course. So I have my fan favorites, which Tesla is probably my favorite stock to trade. I was very bad at trading Tesla for a long time, and then finally I started to kind of understand the rhythm of it, and now it's one of my favorite stocks to get into. So that's definitely a favorite. I like Amazon, Apple, NVDA, AMD. Anything with like high liquidity. I like to stick to tech stocks because they're volatile and they have that good liquidity. But when I want to trade the indices, I'll just use the SPY, the QQQ, sometimes SPX. But yeah, I keep it pretty simple. I have a watch list of stocks that I, of course, watch on a daily basis, but I have my 5 or 6 go-tos that I'll trade on a daily basis.
So do you need to see the markets in an uptrend to be buying calls?
Not necessarily. Of course you want to stick with the trend, but like for example, I was trading AMD puts today and we made money, and AMD was mostly in an uptrend today. So sometimes you can short an overextended move to the upside and catch a pullback for 10, 20, 30% and call it a day. Options will move really quickly based on a little move in the underlying. That's the beauty of options, is you have leverage on your side. You're putting up a smaller amount of capital obviously than it would cost to short the stock or buy the stock, and your percentage gain on that capital can be a lot greater than if you're just long or short the equity itself. So I have a few different strategies that I'll use, different technical analysis patterns, like a double top or a rising wedge, these classic patterns that just continually repeat themselves. And I essentially look for those to populate on the screen on the charts. And then I'll look into the options market to make sure that, I'm on the right side of the trade. Because if I see a bullish setup, but the options market is just continually, puts are just coming in, people are showing their bearish sentiment, obviously that should give me pause. So I want to make sure that everything is lining up, and that's going to, give me the best chance of success.
Where do you typically find your flow, your options flow? Is there a go-to website?
Yes. So I use Black Box Stocks. They are my favorite. And, they have the most flow. They get the most flow. It's very well organized. I can quickly, see what I need to see, and it's all color coordinated. So it's almost like a secondary, your brain automatically understands what it's seeing before, you even read through all the numbers. You see it's a certain color, okay, the open interest has been exceeded on this particular line. So they make it very simple, and that's the one that I use.
Gotcha. Now, I assume you also do puts in addition to calls?
Yes. I could care less.
When's your favorite time to play puts? Is it, when you see the underlying stock get rejected at a resistance level, like, say gets rejected at the 200-day moving average? Is that when you typically look to buy some puts, or do you have other favorite ways to play it?
Yeah, that would be a great time to get short or via long some puts. Typically I've been more of a breakout or a breakdown trader. So, let's say like a stock has been hitting support, over and over at the $100 level after pulling back from 120. Let's say it gives through that 100 level, that's when I would be getting long, the 98 put, the 95 put, something like that, looking for a continuation downward. So a continuation of the trend, and vice versa for calls. But like you said, shorting into a resistance level is another great way to get, into puts as well.
Gotcha. Like for instance, I mean, I do own a stock called DigitalOcean, DOCN, and for the last couple of days, it was getting rejected at the 200-day, and then finally today, right at the end of the day, it started to push through. I mean, I guess you could have shorted it yesterday when it got rejected, or bought some puts, but then I guess today that maybe that trade wouldn't have worked out in your favor. How long do you typically own your options contracts?
So when I first started trading, I was more of a swing trader, and I'd buy, a month or 2 months out, maybe even 3 months, and, look to hold for a week or two. And then as I've gotten more intensive and more focused with it, and now I do it full time, I've shortened my length of holding period. And it's basically just to manage my risk, because, options obviously don't trade after hours. So if something happens in the market, news related, a position can move against you significantly. So I feel more comfortable being in and out before the end of the day, basically. So pretty much sticking to day trading.
Okay.
And if I am going to swing a trade, I just make sure that my position size is the appropriate amount, so I don't get hurt if, God forbid, something terrible happens and it moves against me.
Do you ever play options into earnings? And if you do, what sort of, position size or cushion do you need to do that?
So I used to, when I first started trading, I used to always, think I was going to be able to get the direction right. And sometimes you do, you'll buy a far out of the money call if you're bullish on the earnings. And sometimes you get right, sometimes you're wrong. And, I found that my success rate was about 50-50. So I just stopped doing that.
Okay.
You can get similar odds, betting on black or red at the roulette
Right.
table. So I think if you are going to trade earnings, the way to go is like an iron condor, which is basically when you're short premium. So you'll sell an upside call spread and you'll sell a downside put spread. And there's a way that you can calculate what the market is implying the move will be, what the options market is expecting it. So you can go just beyond those parameters. And if the stock closes anywhere in between those legs, then you're going to profit. You'll make money on the trade. So I think like a directionless short premium strategy is the way to go with earnings.
No, if you're doing this full time and focus on options, how many contracts would you typically have open at the same time? Or, how many different call or put options would you have in your portfolio at any specific time?
It depends on the cost of the contract. Maybe I'm trading 10 lots, 100, a few hundred, it just depends. As far as positions, I like to stick no more than like 2 or 3. It's rare that I'll have more than that open at one time. Usually it's honestly just one trade at a time. I just stay laser focused on what's happening and just give all my attention to that.
Interesting. Okay. I wouldn't have guessed that, but, and then what's like a typical, see, it's different. Like I'm not really a big options guy. One of the reasons I wanted to bring you on the podcast is so that I can learn your strategy and learn more about options in general, because it's really nothing that I do in my, my own investment strategy. I'm the classic stock picker, mostly growth stocks, 20 to 30 positions in my portfolio, anywhere from 1% to 10%, based on conviction and all of that good stuff.
Sure.
But, over the last few months, a lot of my stocks have rallied pretty big off the bottom, 50 to 100%. Not all of them, but some of them have. And a lot of them have crushed it on recent earnings. And I'm just wondering how much money I'm leaving on the table by not adding options to my strategy. But I don't want, I'm already in these high beta growth stocks. So I'm not looking to add crazy risk. But, like someone like myself starting off, what would be a good amount of capital to allocate to options? Is it 5% of my portfolio?
Well, I don't know. It depends. I mean, if you got $1,000 portfolio, you probably need more than 5%. But I'd say whatever you're comfortable losing, right? I mean, most option traders lose money in the beginning, so I definitely advocate paper trading to learn how options will work and move. Another great way to get introduced to options is with covered calls or cash covered puts. So let's say you're long, 100 shares of a stock, and it's rallied, enough significantly where you're even ready to maybe start taking profit. profits. Instead of selling the stock, you can just sell an upside call. And if the stock price moves above that call strike, you'll lose your stock. You'll sell that stock at that stock price, but you'll also get to collect in that premium, which can be really profitable, especially on some of these really high volatile names, which really have high premium. And then the other way to look at it is a cash covered put. Let's say you're ready to initiate a new position in a stock, and it's, you know, bottomed out and you're thinking that it's about to turn higher. You can sell a put that's either at the money or maybe slightly out of the money. And then if the price closes below that strike price, you'll now own that stock at 100 share multiple, however many contracts you sold, and you'll also make all that premium. So there's actually strategies, they call it the wheel, where you'll just continually do that. You'll sell a put until you get assigned the stock. Then when you get assigned the stock, you sell a call until it gets taken away, and then you sell another put. So you're just constantly filtering back and forth between being short puts and short calls, and just collecting premium all the while.
So one of the, you know, my opinion on the market is I don't think we're in a bull market again. I don't think we can be because of yields and valuation. I don't know if we're going to go back and test the lows from October. I think we're just going to be in a choppy sideways market for a while. Is that the right market to be selling calls and cash covered puts because you can generate some income while your stock just goes sideways?
Yeah, absolutely. That's definitely a great strategy for that. A range bound to slightly upward trajectory is perfect for that strategy that I just mentioned. You know, another option, no pun intended, would be an iron condor. Now that's basically when you're putting on two legs at the same time. You're going to sell an upside call spread and a downside put spread, and your goal is just for the stock to stay in between those two ranges. So let's say you have a stock that's bound between.
Let's use Celsius, for instance, which is my biggest position, and I'm still very bullish on the stock longer term. I think this could be a $200 stock in the next 3 or 4 years. So I would prefer not to have the stock called away from me, but
Sure.
at the same time, I wouldn't mind generating some premium income off of it. So what would an iron condor spread look like on something like Celsius?
Sure. So it looks to me like recently the stock has kind of been stuck in that 80 to, you know, topped out around 120 or so.
Yep.
So right now the stock is kind of towards the lower end of that range, about 88 and change. So one strategy you could do here is just sell a put spread. So you could sell the 75 put and buy the 80 put. I'm sorry, sell the 85 put and buy the 80 put. Or you could, you know, sell the 80 put and buy the 75 put. Essentially, you determine how much risk you want to take by the width of the spread that you're putting on. So because it's in that lower range, I wouldn't even bother selling a call spread at this time.
Okay.
I would wait until it got up into the 100 range, right? When it's kind of in the middle of where it's been trading. And then you could sell you know, the 120 by 130 call spread, you know, call it 10 points, and then maybe the 80 by 70 put spread, 10 points to the downside. That would give you a pretty balanced iron condor. You could go roughly, you know, 60 days out to expiration. That's when theta is really going to start to decline the most. And as when you're short premium, you know, theta decay is on your side. So you don't want to ever go beyond 60 days, essentially.
Okay. Because if I'm selling puts and the stock goes lower, I just end up with more shares at a cheaper price, right?
So if it's a cash covered put, yes, you would. In the scenario where you're selling a put spread, you would essentially be risking the width of the spread. So let's say, just to make the math easy, you sold the 80 by 75 put spread for $1, right? You're collecting $1 to do that. If Celsius closed below 75, you'd lose that $4. So usually when you're short premium, you have a higher success rate, but you're always going to be having to take a little bit more risk than reward. Like, for example, if you had bought the 80 naked put and it goes down to 75, that at that time would be worth $5 because it'd be 5 points in the money. Gotcha. So there's definitely a trade-off when you're being short premium. Now, but if you're happy owning the stock at 80, then you could definitely just sell it, the put by itself.
Yeah. And in something like this, I might, you know, I almost feel like I should be selling puts on the stocks that I'm the most bullish on for the next couple of years, you know, Celsius,
sure,
Uber, and a couple others. Now, what about leaps?
Yes, that's a good point. You know, let's say you're like you said, a long-term investor, you believe in the company and you want to be, a participant in the long term, a leap is a great idea. You could go at the money, for a nice delta, 50 delta roughly, or, slightly out of the money. And, as long as the move occurred, in the somewhat near future, it should definitely appreciate more than the actual stock itself. And there's nothing to say you can't, mix in a few leaps with common equity itself. Maybe you have, an 80% equity to 20% leap, position overall.
So let's say, because I do think that Celsius ends up getting acquired by Pepsi. So a few months ago, Pepsi took an 8.5% stake in the company. And I do think at some point they're going to end up buying Celsius. But it may not happen in the next 6 months. It might be 12 months, 18 months down the road. How long are leaps? Like, are leaps a year out, 2 out, 2 out, 3 out? I mean, and Celsius is not like a high volume option stock. So I'm not even sure if there are leaps available, to be honest.
So generally they're about 2 years out. So you could buy 2025s.
Okay.
I can check the volume.
And what sort of a premium do you pay on something like that? If the stock's trading at $88 now, what kind of a premium would I pay to get leaps 2 years out?
Let me look and I'll tell you right now. So we can buy the January 17, 2025 leaps. Basically for, let's call it 90, the at the money, you're looking at $34.
Okay.
Which would be 3,400. You multiply any option contracts price by 100 whenever you're considering it. So for $3,400, you're controlling 100 shares at that 90 strike price. Now, you don't necessarily have to buy the at the money call. You could buy the 120 call or the 150 call. They go all the way up to 170.
And they'd be normally cheaper the higher you go on price.
Correct. So the 120 call would be $2,000 and change. The way that you would think of it when it comes to what strike price you choose, the closer you go to the money or in the money, which would be any call that is when the strike price is below the current price, that's considered to be in the money. You're going to pay more, but it has a higher delta. So as the price will move in your favor, you're going to make more money in that sense. Now, if you buy a further out of the money call, like for example, the 100 call would be out of the money for Celsius right now, you will, let's say you're correct, you'll actually have a higher percentage gain on your money. So you have to ask yourself, do you want to actually put up more money to make more money, or are you interested in risking less capital but having a higher percentage gain? That's the best way to look at what strike you actually choose.
Gotcha. I assume you don't do much with leaps, right?
I bought a few during the pandemic, just when things seemed really, really cheap, but I currently don't have any with me now.
Okay. Talk to us about Theta Warrior. I mean, I know there's something that has to do. Theta is a part of the options vocabulary, but I'm not exactly sure what. So can you explain what is theta, what is decay? Because these are terms you hear that I'm not sure most people understand.
Sure. Yeah, of course. So theta is simply just the rate of decay of an options contract based on time. And every single options contract has an expiration. And at that expiration, the option contract will be worthless if it's out of the money, and will only be worth the amount that it's in the money. So if you have the 70 call and the stock is trading 75, it's only going to be worth $5. But before expiration, it may be worth 76, even with the stock price trading 75. Now that amount that it's above the true intrinsic value, that $1, that's known as theta. So theta will go, that's known as the premium. So theta will erode away that premium over time. So as someone who's essentially always long premium like myself, I'm always battling against theta. So that's why I consider myself the Theta Warrior, right?
Do you ever hold options to expiration?
No, never.
Even if you're buying will you buy any of these 0 days to expiration?
Sure.
Okay.
Yeah. But I don't ever, I always get out by the close.
Okay.
the only time I would ever hold a contract to expiration would be if I was doing like a wheel strategy where I sold a put and I'm okay owning the stock, or I sold a call and I'm okay losing the stock. That would be the only time I'd ever hold it. But as far as like trading goes, I never hold to expiration.
Gotcha.
But yeah, Theta is one of the four main Greeks they're known as for
Right.
options contract. The other three would be Delta, Gamma, and Vega. And basically they all determine how an option pricing will change based on, the move of the underlying stock itself, the rate of that move of the underlying, the theta, the time, T, theta time, and then the Vega would be which volatility, so the VIX. So all four of those parameters will change the pricing of an option contract.
And now when you're looking at option contracts available, all of that information is listed there, correct?
Yes, absolutely.
So how do you determine which one to buy? Like, let's just say you want to get long some NVDA calls. How do you decide which strike price, which expiration, like what goes into your thinking behind that?
Sure. So typically, like I said, I'm more of a shorter term trader. So I'll usually stick with the weekly call, the one that expires, whatever the week of, the Friday of. And typically I go with about a 40 to 50 delta, which is, slightly out of the money or slightly at the money. And there's a bunch of reasons for that. I won't go into too much detail because I could take forever talking about that.
Well,
But
I mean, feel free.
It basically has to do with theta and the rate of decay. And when you look at, the different amounts that theta will have based on expiration and where it is at the money, I've just found that it seems to me that the best contracts to buy are going to be at the money. So that is, if the stock is trading 100, that's going to be the 100 call or the 100 put. Like I said, sometimes I'll go a little bit out of the money just because I want that better, risk reward in terms of a percentage gain. But that's typically where I stick. Now, if I expect a move to, take a few days to occur and I'm looking for a swing trade, then I'll go out a couple weeks. Maybe I'll go to the monthly expiration, 3 weeks. It'll just depend on the setup. But most of my stuff, I trade the weekly options.
And when you say setup, you're looking for a stock that you think is going to break out or bounce. Like maybe you can show us a couple stocks that are on your radar right now and why you like them and, when you'd pull the trigger on something.
For sure. So we'll talk about my favorite here, Tesla. Tesla, had a big rally off the lows. You can see my screen, right?
Yeah, I can.
Okay. Big rally off the lows, maybe a little bit too far, too fast, got rejected right here at this 200 SMA, formed a big inverted cup here, a rounded top, you might call it, and it's starting to pull back. And just today actually lost its support level. So, a common retracement for any stock move is about 50%, which would be, 159 and change right there. So obviously the stock isn't going to get there tomorrow. So, if you were going to be looking to initiate a short position and you had this as a target, maybe you'd go out a week or two. You could buy the 180, 160 put spread. You could buy the 170 put spread on its own. If you were going with this week, a bunch of traders in our room, traded the 185 put today, which went, decently in the money here. We got a nice little move to the downside. So yeah, it just depends on, each trader, their risk tolerance, their time frame. Not everybody has the luxury of day trading, so maybe they want to buy a little bit more time for themselves. But yeah, I think this is a great short setup right here, Tesla.
And how quickly do you take profits? I mean, if you got into the 185 puts this morning, I'm not sure how much they were up. Are you like you're going to close that out by end of day?
Yes. So I have a method that I'll use for scaling. I'll basically scale 30%, 30%, 30%, and then I'll leave 10% as a runner. That's how I do it. Because obviously I don't know where the top is going to be, and I'm trying to get like a blended sale, throughout the move of itself. I always will sell into an extended move when I think price is getting stretched. And, for all of my day trades, I'll, trade off of a 5-minute chart. So I'm looking at, much lower time frame. You can see we got the move to the downside pretty quickly this morning. And then I'll leave 10%, as, let's say it moves a little bit further tomorrow or the next day, then I still have a little bit of piece of the position.
Now, I guess when you're doing mostly day trading, you don't have to worry about, like you said earlier, the after hours news releases or pre-market news releases, analyst upgrades, downgrades, all of that stuff. I guess you
Correct.
just have to worry about the intraday, direction. Now, what about, you have Powell talking today in front of Congress. I assume you're watching the TV and I mean, you're watching Tesla. And if this thing starts to reverse intraday, when do you get out?
Yes, so I was watching the testimony today as I was yesterday. I actually didn't trade at all yesterday, which is definitely something that people need to remember. You don't need to trade every day. If the price action isn't suitable, if you don't feel comfortable, if there's no setup, there's no need to be in a trade. But yeah, I'm watching everything, and I have my stops in place. That's another big part of my strategy. As I'm trimming, let's say I trim my first 30% of the position when I'm up 20%. That's generally my spot, 10 to 20% profits. When I'm in the green, I'll start trimming. I'm moving a stop up on the remainder of my position. So first it goes to break even, then it goes 10% in the profit, 20% in the profit, based on how far I actually go into the green itself. So if something happens and Powell says something to rocket the market higher, I'm going to get taken out of my position, in a still a profitable way. So that's a big part, I think, with options trading is you really have to be disciplined. You can't just hope that something's going to come back. And, even if you step away to walk the dog, I mean, a lot can happen in 5 minutes in the options market.
Now, if you're selling options, are you holding those longer?
Yeah, so certainly if you're going to be short premium, you'd need to be comfortable holding overnight. That's why a vertical or a debit spread is a good way to go, because you're limiting your risk. Whenever you're short a naked contract, you in theory have unlimited risk, except for with a put, which can only go to zero. If you're short a call, then you have unlimited risk. But yeah, if you're selling the weeklies, you're selling on a Tuesday, you probably hold it until Thursday, Friday, something like that.
Now, let's say, so pull up Etsy. I don't own Etsy. I haven't owned Etsy in 2 years, just to be clear. But today it got smoked and it bounced off the 200-day.
Yeah, I was actually just looking at that before we got on the phone.
So like, let's say I was stalking the stock. Now, granted, I didn't catch it in time. And by the time I looked at it, it had already bounced. But if I had this one on my radar and I was looking for that thing to bounce off the 200, rather than buying the stock on the bounce, I could have bought the options, right?
Yes. So in this case, I would have got the 110 call, which would have been right around the money at the time. With options, generally the best liquidity is going to be on the 5 intervals. So like the 95 call or the 100 call, the 105 call, the 110 call, and so on and so forth. The 2.5 strikes usually don't have the better liquidity, except for with a stock like Apple or Amazon when it doesn't matter. But this stock, the 110 call probably would have had the best. Obviously that would have worked really nicely. You got a beautiful hammer there.
Oh yeah.
On volume. If you're going out a week or two or even to the monthly expiration, the 120 call would have worked fine. You could have also done a 110 by 120 call spread. So yeah, that would have been a great trade.
And when do you typically buy it? I mean, there's no guarantee that it bounces off the 200-day. We all know that. So do you, like, if you were going to play this, would you wait until it bounced? Would you wait until it got as close to the 200-day as possible?
You know what? Let's take a look and see what it did intraday. So, okay, so this is something that I would look for. Obviously, the stock opened down and, had a big red sell-off. You got a higher low and then a bounce after a lower low. So what I would do is, connect these lines here, and you've basically got, a little falling wedge.
Okay.
So once this price pushed above this level, I'd say that's a buy right there.
Gotcha.
And what I would do is I'd start looking to take profits when it reached that first secondary high, and then probably, with me, be out of the whole position by the time it reached up there.
Okay.
The way that I look at it is, if you get a retracement like it did right here, nothing to say you can't buy back in once it found that support at that previous resistance level. You're looking for that resistance to support flip. Now, of course, if you're going with a longer dated expiration call, you might just buy it in this region and just hold it, because obviously we all know stocks like to fill these gaps. So
Yep.
Probably price will revisit this 115 area eventually in the next couple of days, maybe even tomorrow. And then I would just be looking, for the next possible resistance level where I might want to take profits, which kind of looks like up in this 122 change region.
And then another stock that I was looking at today, which I actually got into, I'm trying to think which one it was. Shit, let me check my my spreadsheet. I bought it, I bought an equity position as I thought it was going to bounce off the 50-day, and it sliced right through. So
That'll happen sometimes.
oh yeah. I'm just
But that's the beauty of a stop loss, right? It's there to
exactly.
protect
So I'm
you.
just wondering where I could have put that stop loss. So INSP, Inspire Medical. So if you throw a 50 on that, I started a position right above the 50. And I had my stop loss less than 1% below. So I got out with a small loss. But if you're trading options, it's a little bit different.
Right. Yeah. I mean, like you said, 1% is nothing. I would say probably you'd have to definitely bail by the time it lost the low on that candle, even though it did recover. Like I said earlier, it's never something that you can bank on. The price is always going to recover like that. This could easily keep going. A really tight stop probably would be below that area right there, but that's probably about where you were getting in, was that right around that 50 test.
And how do you set stop losses on options? Are you just watching the underlying stock, and when it breaks a certain level, you just sell the option?
Yes, so that's how I do it. That's the more advanced way to do it, and you have to do a little bit more work on the back end to make sure that it's not going to be an exaggerated loss in the options contract. But the more typical way, the easiest way is, of course, to just set a 20% stop loss or a 30% stop loss on the actual option contract itself.
Okay.
But I use Thinkorswim for my trading, TD Ameritrade,
Yep.
and you can set it up that way, of course, but you can also set it up to say, if INSP goes below 252.35, take me out of this trade.
Oh, really? Oh, interesting.
Yeah,
okay.
for sure. So you have to make sure, that your position size, because let's say you buy in right here, you could be down 50% on the position by the time it gets down there, or even more. So you have to make sure that your position size is going to be appropriate to getting stopped out at that level if you're going to take that much risk, because that's a lot of meat on the bone right there. 4 points and change with an option contract, that'll really move.
So let's say, a stock. I mean, I'm trying to think off the top of my head which stock I bought recently. Trying to think what stocks bounced today off like they're 21 or 23. So, so Etsy bounced off the 200, Meta bounced off the 6. Okay, so so CROX bounced off the 21 today. That's in my trading portfolio right now. So if you were looking to play the bounce off the 21, let's say the stock, it does bounce, and off, over the next 3 or 4 days, the stock goes up another 5%, and you bought the 130 calls, expiring in a month. What sort of upside would you expect to see in the options versus the stock?
It's hard for me to calculate that off the top of my head, but there's the Black-Scholes model is the classic, way to determine how much an option contract will move, and it factors in all of the Greeks basically.
Okay.
The easiest way is just basically calculating the delta change. So let's say you're buying the at the money call, and the stock, which is a 50 delta. If the underlying stock itself moves up $1, you're going to make 50 cents on that option contract, or $50 per contract. So you can multiply that by 10 or 100 or however many you're long.
Gotcha.
And then as that contract gets deeper and deeper in the money, the delta will increase. So let's say now, the stock is trading 128, you've got the 125 call, that delta might be 70, 80, depending on the expiration, and you're going to make 70 cents to 80 cents now for every dollar that goes higher. So that's why options will be like an exponential, way to profit. Essentially, it's not like a 1-to-1 ratio like a normal stock would move.
Because my entire strategy right now, and granted, we're just coming out of earnings season, so this is why I'm doing what I'm doing, but I keep a spreadsheet of all the stocks that gapped up after Q4 earnings, and I stalk them because I'm looking for them to pull back, after they start to fill that gap, or they just, they digest some of the gap up, and now we're waiting for the moving averages to catch up. And I love to start those new positions as they pull back to their 10-day, 21-day, 23-day, etc. and a lot of times they do bounce, and I'm just wondering, like, why am I buying the equities on those bounces instead of options?
Yeah, well, I mean, I think, it's important to stick with what you know, and if you're comfortable in, investing with equity, then, and it's working, I'd say keep doing it. But nothing wrong with, playing with some options. I think, for anybody who wants to get long a contract, buy some time, buy it, at the money or near to the money. And before you even do that, of course, paper trade, and kind of just learn how they move, and different expirations are going to move different ways, and just kind of familiarize yourself. But yeah, there's definitely something to be said about implementing the exact same buy the dip strategy that you've been using, and kind of filter in some options there. And if you do it right, they could definitely kick up your returns, I'm sure.
What are the biggest mistakes that people make when trading options?
I would say risking too much, having too big of a position, listening to their emotions. When you have the potential of losing money, people tend to do bad things. And
Right.
I think that, having too much risk is will lead to that. So, give yourself time to learn, how options move and how options work. Read a few books, watch a few YouTube videos, and actually get out there and paper trade. Don't expect to get it all overnight. Don't expect to make money overnight. It's definitely a process that you have to be committed to doing. Options, there is no money created. If you make money, it's because you're taking it from somebody else. That's how the options market works. So it's dog against, it's dog eat
Right.
dog out there. You have to, be the better warrior to walk out of the ring. So, it's, something that you really have to take seriously.
And I assume one of the mistakes is, and I've made this mistake myself, is not taking profits fast enough. You buy a call, it goes up 20, 30, 40%, and then you get greedy, you hold on to it, and
Right.
whether, that decay or whatever else it is, and now that premium's gone.
Right. That's got to be one of the worst feelings, right? Seeing a green trade go to red, and we've all been there.
Oh, yeah.
A simple way to do that is, let's say you're up on that contract 40%, you put a stop loss in at 30% or 25% or whatever it is you're comfortable losing. Another really good mentality is, thinking that there's no such thing as house money, right? So let's say, you make profits on a trade and you're putting it into another trade, thinking, okay, well, I'm just playing, with the house's money here. That's a bad way to think, because once that money is in your portfolio, that's your money, right? You need to protect that money. So I think that people foolishly will, falter into that and give back too much of their gains. So a lot of the market, is not necessarily about making money. It's also about protecting money.
What about some of these ETFs like JEPI? I'm not sure if you're familiar with them or not. These call writing ETFs. Have
Yes.
you ever looked at these things before?
Yes. Actually, I own JEPI myself. I am an investor in JEPI, and I own it in my long-term stock portfolio. So I am a trader by profession, but I, use my profits from trading to, pay for my lifestyle, and also invest in the stock market because I'm long-term bullish on the stock market myself. So JEPI is one of the stocks that I own. It pays a killer dividend.
Oh, it's ridiculous. It's like 1% a month.
Yeah, it's crazy. So very happy with that. And, I just reinvest my dividends and just let this thing cook. And, when you look at, the returns that it's had against the market, it outperformed the market last year. I'm not exactly sure how it's doing this year, but it was down less
It
than
was
the
up
S&P.
I mean, the market was up. I haven't looked at it in the last few weeks. I mean, it was certainly trailing the market this year, which, I mean, you'd expect to do it in a bull market. It's going to trail in a bull market, but it's going to save your ass in a bear market.
Right, exactly. So the stock, the ETF will invest in, dividend paying stocks. And also they use a strategy which it's called EINs, I believe.
Yep, I think so.
And basically they're just like a security that will, sell a covered call against a stock position. And I believe that they just buy them. They don't even necessarily have to own the stock that they're writing the covered call against. So they'll collect all of that premium, from some of these higher volatile names. And that's how they generate that higher return. And I think it's yielding like 11% and change right now.
Sounds right. And there's a couple others that are actually even higher than that.
Right. Yeah. The JEPQ is also done by JP Morgan, which I don't own any of that, but I don't know, 15%, I got to look more into that. That seems too good to be true.
It almost seems too good to be true.
Right.
I mean, and they've been home runs. I mean, I believe that JEPI has at least $20 billion in assets in it now. So, I mean,
Yes.
there's been so many people that have gravitated towards this, I mean, I know short-term Fed funds and money market accounts are going to get you 4 or 5%, but this thing looks pretty juicy at 12 to 15.
Yeah, I don't think that it's going to be like a stunner in terms of like doubling in equity price. But I
No,
mean, if you're
definitely
happy
not.
to sit there and collect 10, 12% a year, on your money, like I think this is a great option.
For sure. Could someone replicate that strategy themselves?
Sure. Yeah, absolutely. For example, I own AMD and NVDA, and when I think things are getting too hot, I'll sell calls against it. When AMD took a big dip, this past year, I wrote some puts, got assigned some, didn't get assigned others. Just one of those things. But yeah, I mean, generating 10% returns on the stock price might be difficult, but when you factor it in with the upside potential of it, you can certainly juice your returns absolutely by selling some calls and writing some puts.
So if I have let's just pretend I have $1 million portfolio and I'm writing calls and puts on a lot of my positions. What can someone generate a year in income, premium income?
It would be it would be hard to say. I would say probably 10 to 15% would be modest, maybe 20 to 30% if you're writing contracts that in those higher volatile names. It's really just going to come down to what stocks you're using for that strategy.
And it depends on the market too, right? Like the volatility in
Yeah.
the market and where premiums are.
Mm-hmm. Like, for example, Tesla would be an excellent stock to sell premium, but it moves around so much, it'd be difficult to do. You'd have to really be watching that pretty closely. A stock that just sits there is not going to have very good premium, but it's going to be easy to manage. So it's a trade-off.
Gotcha. Okay. Anything else you'd like to share before we wrap up? I mean, first off, I'll put all these links in the show notes, but people can find you on Twitter at Theta Warrior. And then what's the website that you operate?
Right. So the Twitter is Theta Warrior. Actually, this is my private Twitter here, which I'll discuss that in a second.
Just for members, I assume.
Yeah, so it's at Theta Warrior is the public Twitter. I post trade ideas and interesting things that I'm watching. If anyone wants to join the private group, Theta Warrior Pro, we sell the education, the alerts, the community, everything on a monthly basis. All of that is on the website here, which is thetawarriorpro.com. We have a merch, we have some education, different partnerships, that we offer, like the flow service to Black Box and TrendSpider. We have discounts and stuff like that. And then the actual elite membership sign up stuff would be right here. So yeah.
I'm a big fan. I mean, I'm a big fan of Black Box. I don't use their service right now because I'm not doing any options, but certainly TrendSpider. I mean, I'd be dead without TrendSpider. I mean, I probably spend 8 or 10 hours a day on TrendSpider.
Oh my God, me too. They're fantastic. They have a great team. They offer a great product, and I mean, there's so much stuff that this can do that I haven't even tapped into, like some of the automated trading bots and stuff that you can create. It's phenomenal.
So I might do a webcast with the guys from TrendSpider so they can sort of walk me through the trading bots. I know, was it Trade Signal? I forget the name of like the new service they've launched, but it does look interesting.
Yes, and I know for a fact that they would love to do that with you.
Okay,
and
cool.
They're great guys for sure.
Now, what about so if we're looking at the charts and TrendSpider is awesome for adding moving averages, adding VWAPs. How often are you buying calls based on where you think a stock might bounce? Like if you see a stock pulling back, you think it's going to bounce off the 50-day or a VWAP. Does that interest you?
Yeah, of course.
Okay.
I use what's like known as a top-down approach, where I'll start with the weekly or the daily chart. I'll form my thesis, and then I'll dive in, to the 15-minute or even 5-minute candles, and that's kind of where I base my execution off of. So, if I'm expecting, like, for example, Etsy to find support at the 200 SMA, I've got that pulled up, I'm ready to go, and then in the morning when it comes in, I'm watching it on the lower time frame charts, for that reversal to come in and that's when I'd look to enter calls there. So, on a day-to-day basis, I might be in calls in the morning and puts in the afternoon. I basically just go with the market direction.
Gotcha. Okay.
Whenever I can.
Very interesting. Well, thank you so much for joining us today. Really, really appreciate it. Definitely want to have you back again in the future. Maybe once I do a little bit of options trading myself, I can come to you for therapy and you can tell me what I did wrong.
Please. I'd be glad to offer some insight. And thank you very much for having me on, and congratulations to you and all your success. And yeah, let's do this again sometime.
Awesome. Thank you, man. Really appreciate it. Have a great night.
Thank you. You as well.
Talk to you soon. Bye-bye.